Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This is going to be an incredibly important video. We've had some wild moves on the markets throughout the past few trading sessions on the SP 500. We obviously recently had that new Omicron variant announcement that triggered a large rapid drop on the SP 500 here. And of course, we had the Federal Reserve make their announcement that they would potentially begin accelerating tapering. That's brought a lot of fear and uncertainty into the market. But primarily, this was energy that was stored up in the moves that we had throughout the past couple of weeks. The market doesn't go up in a straight line, right? You have rallies, you have counter corrections, and when you have price at resistance, building divergence, and then you have a couple of bad news events, that can trigger a rapid drop. Does that change anything about the bull run that we've been in, this massive, unprecedented rally that we've seen on the S&P 500? So we're going to dive deep into what's happening underneath the surface on the S&P 500. Does this represent an opportunity? Is this the beginning of a much larger move down on the stock market? If you're new here, make sure to smash that subscribe button. We look at the economy, the macro environment, and how we can successfully navigate today's market. And now, without further ado, let's get right into it. All right, so let's quickly begin with an overview of the technical structure on the S&P 500. We obviously have this nice bullish price channel here that we've been looking at for quite some time. Very well defined, both in terms of the resistance levels and in terms of the support levels. Now let's just step back for a second and see what's happening on the weekly chart, right? Sometimes it's important to look at the broader context before we actually dive deep into what's going on over the past few trading sessions. Now the S&P 500 has been in a bull run since 2009 here, been trading within that price channel on this weekly chart, right, throughout the last 10 years or so. And then here in 2021, we had this breakout, retest, another retest, and resumption. So we have broken above this price channel. This is the type of thing that happens towards the end of a bull run cycle. When price starts to get overextended, you have a lot of speculative price behavior, a lot of optimism. So we do believe that we're in that part of the cycle. And so it's now our job to tiptoe around this environment and see what type of trades we can take, because the end of a bull run is often when you have the most amount of gains in the shortest amount of time. That's something we've said many times already, and it's been proven right over and over again with the relentless runs that we've seen on the S&P 500. But make sure to keep this technical picture in mind to give you that bias. We've just seen a breakout and we have very strong support just under us here. Now, coming back to that shorter term time frame, I do want to show you something before we look at the big indicators that we've been looking at recently. Look at what's happening here. We have price making a lower low and the RSI making a higher low here. So that is divergence. If you were watching our channel back here in September, especially October here, we had divergence with price making a lower low, RSI making a higher low, and that would likely mark a significant bottom that would never be seen again for quite some time. That's how divergences work. When you have a recovery from a divergent low, it marks a significant bottom. Now, we're not in exactly the same technical position as we were back here, and I'm going to show you why in the rest of the video. We do have similar divergence, although this one is a lot smaller than the one we had in September and October, but there are quite a few key differences between what's happening now and that October low. And the first one is on this chart right here. This is a chart we've looked at before. This is the ratio between the NASDAQ 100 and the S&P 500. So it tells you how well the tech sector does relative to the broad market. If this is rising, tech is leading, tech is outperforming. If this is falling, it means tech is lagging behind other sectors in the S&P 500. And ever since around May 2021 here, we've been in this price channel range on this ratio that has been respected as both support and resistance. And if we look at where we were in October 2021 on that low that we just talked about, we were at the bottom of the channel testing support. And if we look at where we are now, We've just had a major run and tech is now at resistance. Now, if we look at what impact that has on the market, if you know anything about what type of market environment we're in, you'll know that we have a market that's in large part driven by the technology sector. So we need tech to rally if we want to see the S&P 500 rally, right? And you can see that when you have big drops in this ratio of the NASDAQ 100 relative to the S&P 500, you tend to see the S&P 500 come down. It tends to correspond to periods of consolidation, right? Same thing here, violent move down on this ratio, move down on the S&P 500, move down in September and October, move down on the S&P 500. So that's one thing that tells me that we might not be quite done with this correction that we're seeing. Our short-term convictions on the market are never very high, right? That's something that you need to understand. We look for multi-week, multi-month opportunities. We're not looking to day trade or take advantage of small candles, but this is something that we are paying attention to as a potential risk to entering new positions right now on the S&P 500. That's why on the ratings across asset classes that we post every couple of weeks on our website on gameoftrades.net, we made our short-term rating for the S&P 500 a weak buy. And I'm going to give you the other reasons for that in just a couple of minutes. But if we start to see the technology sector come down here throughout the next few weeks and the S&P 500 consolidate, that weak buy is going to turn into a buy and then potentially even a strong buy if we get to the lower end of that range. And by the way, just a quick ad here. This is part of our service on gameoftrades.net. We try to give you guys our convictions across the entire markets, across different sectors within the S&P 500 to tell you what our convictions are in the short term, intermediate term, and longer term. This is one of our members' favorite features. It really gives a broad overview of everything that's happening in the markets and lets you identify opportunities on the time frames that you want. Okay, so you may be wondering why we're putting a weak buy rating when we're expecting tech to pull down the market. And I do have a few answers to that. First of all, whether you like it or not, nothing is 100% in the stock market. Our short-term convictions are never 100%. So if we expect stocks to continue going up throughout the next few months in the current macro environment with a lot of inflation, a lot of easy monetary policy, putting a sell rating just based on some short-term convictions of maybe another couple percentage drops just to see the markets bounce back again a couple of weeks later, that doesn't make sense. I see a lot of people doing that mistake on the internet, being obsessed by short-term bearish signals when really you should be focusing on those larger trends and not trying to time every single top, every single bottom. That doesn't matter. And we take that into account for our members to try and make our convictions as clear as possible. It would start to get really confusing if we start to put sell ratings just for some short-term downside when we're really expecting the markets to eventually be a lot higher. Now, another reason is the VIX here, the volatility index of the S&P 500. It measures how volatile the S&P 500 is, right? This is the COVID crash. Volatility went absolutely wild, and ever since that top, we've been in a massive run, and volatility has been going down with brief volatile corrections. Now look at those trend lines that we drew here. Nice, well-defined trend lines with clean reactions, clean reversal points. And the VIX clearly broke its primary downtrend line here. This is the first time we've had such a development since around 2020. Right, we've used this downtrend line as an indicator for reversal points in corrections, right? Every time volatility spikes and it reverses off that trend line, you get a big rally on the S&P 500. Here we've broken the trend line. Now that tells me that we could be set for a little bit more volatility in the next few trading sessions. But objectively, if you're looking past those short-term moves and you want to focus on that longer-term time frame, you want to be stepping in when the S&P 500 is volatile. Each of these spikes in volatility correspond to buying opportunities. It systematically corresponds to great buy the dip zones. It gives a lot of potential for upside. Now, could the VIX rise a little bit more? Absolutely, but this is still a good opportunity to take some starter positions. Now, another big indicator is the breadth. The S&P 500 stocks above their 50-day moving average that oscillates up and down within this range, right? It tells you how many stocks within the S&P 500 are trading above their 50-day moving average, right? So when you see this indicator going up, it means it's a broad rally. It's a broad, healthy rally, and that can be a very good sign. But when it's telling you that 97%, for example, right here, 97% of stocks are trending above their 50-day moving average, that also means that the index is maybe a little bit overbought and there's too much optimism. And you can see that top corresponded to a nice correction back in June 2020 here. And the exact same thing applies to oversold readings. When you have the breadth, the stocks above their 50-day moving average come down into oversold territory like here, like in these zones that I'm highlighting, it often corresponds to nice buy the dip opportunities, right? Look at what happened to the S&P 500. Every time you hit that oversold reading, it bounced. And right here again in October 2021. So the breadth and the VIX gave a nice risk reward on the stock market. Now again, let's zoom into what was happening back in October. You had a first oversold reading on this dip, but that didn't mark the low. You had another low here with another dip on the breadth before actually bottoming, right? So could we see that type of thing again? Absolutely. But again, we have the same convictions as we had back here. Once we make that bottom, the recovery from that bottom is going to be very powerful and it's going to recover extremely quickly, almost as quickly as you can hit that like button. It helps our videos out so much. If you enjoyed this video, you like the information we put out, you like how we approach the data and how we present it, make sure to help out the channel by smashing that like button. I really hope that these videos help you guys navigate the markets more successfully. Now, in the meantime, I wish you good luck on your trading and see you next time.